Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
Yes, welcome to the About podcast. This is Jeremy Scott, your host, and as I'm joined, of course, by our consummate expert in all things financial, mostly kind of sorta, Roy Hookey.
Yeah, mostly kind of sorta. That's a good way to explain it.
We apparently like to cover things people don't like to talk about. So, we've covered estate planning and life insurance and all that, the one unavoidable thing. Now we're apparently going to talk about the other unavoidable thing, along with deaths. We're going to talk about taxes, the other thing we don't like to talk about. So,
two guaranteed things in life: death and taxes.
Death and taxes. So
we got it kind of covered with you being a pastor and then the tax.
I think
whole gamut.
We got it. Yeah. Well, and the funny thing is, you end up dealing with both. In my line of work, quite a bit because taxes are unavoidable, in people's lives, and it's a big part of people's lives, and it takes a lot of planning and, around that. But I think I told you right as we were hitting the record button, it's like, well, we're stumbling in an area I don't know a whole lot about, other than clergy taxes are weird, and we probably don't want to spend a lot of time talking on that. I don't know that our audience is made up of clergy, though. I'm sure there are a few out there.
Yeah.
But,
well, it's, we just had the tax day this week,
yeah.
April 15th, we hit that. And, it's one of those times to look back, and hopefully you didn't have to extend. But I know a lot of people that did.
I've had to do it. Yeah. The first year I was actually a pastor, I didn't quite get how it worked, so I didn't pay anything. And that's a problem because you're technically self-employed. And so we got a pretty hefty tax bill that first year. And been like, I can't pay this. But yeah.
Well, taxes are one of those things where in the financial planning world, you can make all these really good decisions, have all these really good plans in place, and then make bad decisions around taxes.
Right.
And, and I'm not talking about like filing your taxes right now, right? I'm talking about how do we actually make decisions, and we want to pay what we should pay.
Right. Like I don't mind paying my fair share. I like my roads. Right. I like air traffic control.
Yeah.
Right. I mean, I like these things. There's many services the government provides that I'm local, state, and otherwise that I'm a fan of, but I don't want to pay more.
Yeah. So there's decisions you can make along the way where we can not pay more. Right.
Right.
And one of the areas I hit it a lot, and I'm bringing it up first kind of because it has to do with really nonprofits being, churches, many,
right.
Fall in that range. Hopefully they don't not have that.
Oh, yes. We're the OG nonprofits.
The original, yes.
Yeah. Nonprofits were originally invented because other groups wanted to have the advantages that churches had. Oh yeah. Churches are the OG nonprofits.
Okay. So I have clients that when you save in a retirement account that is tax deferred, the government has an age where you have to start taking money out because you've deferred your taxes, and they're like, okay, you've been doing this long enough. Now it's time to start taking money out and start paying your taxes on that, right?
Oh, is that why?
That's 100% why.
I've always wondered. So, because if you don't, then it's still just sitting there tax-free, and they're not getting their money. They're not getting their money.
Tax deferred, yes.
So they want you to take your money not because they think you need it, because they want their taxes.
Oh yeah, and there's a design behind it that's really not to our benefit, right? So one of the things that happens is people will delay to take their taxes, but if they do that, they're actually walking right into the trap.
Okay.
So right now, like for you and me,
right.
The way the rules are today. At age 75, if we have any retirement accounts that have been tax deferred accounts, we would have to, like a traditional 401k or a traditional IRA, 457, some of those kinds of accounts. Right. We actually would have to start taking money out. It's a calculated number based off a December 31st value of the year prior.
Of the fund, of how much money you have.
Of how much money was in that account at that point in time, right? And that's part of my job as a financial planner is I help make sure clients understand the amount and we get that money out, because if you don't take it out, you're penalized at 50%.
Yeah.
So we will take it out.
What is that? How does that? I've heard about like, if you take this out early, you're penalized 10%. 10% of what? Like 50% of what? Like
10% of the amount you're supposed to take out, or 50% of the amount you're supposed to take out. So if you were supposed to take out $2,000 and you didn't, then they're going to make you take that money out anyways, and they're going to take 1,000 of it and say, thank you very much. You made a boo-boo.
Oh my goodness.
Yeah.
Okay.
So that's why I really stay on top of this for clients. But one really cool thing that they have, and this is one of those things like, how can we make decisions to pay less taxes, not more taxes?
Right.
Or how can we make decisions that, boy, I sure could do this and it would benefit someone else too? And the 501c3s, the charities, the churches, the nonprofits, right? They are the ones that I'm kind of referring to, because you can do what they call a qualified charitable distribution.
Okay.
So the way that
Sounds good.
the way the rules work today, at age 70 and a half, you can actually start doing a qualified charitable distribution.
Okay.
The story around that is, it used to be at age 70 and a half, that's when you had to start taking your required minimum distributions, that calculated number that we discussed.
Okay.
Well, they changed the law on that, on the age, but they never changed the qualified charitable distribution age.
Okay.
So that stayed the same, even though you're not required to do it. It could be 73 to 75 years old now.
Okay.
And, we're in year 2024 here. So it's the current tax code that we're looking at. Anyways.
Okay.
So if somebody has to take out money from their retirement account, even if they don't have to take out money and they reach 70 and a half.
Okay.
But they're like, I give money to my church every year of whatever number. Let's say they gave $1,000 to the church every year. Well, we can actually take that $1,000 from their IRA.
Okay.
It goes straight. It could actually go to them or the charity, but it ultimately gets deposited in the charity's account.
Okay.
And what I mean by that is I can mail a check to them addressed to the church or the charity.
I've received a few of these. Not me personally. I mean,
I think
the church has received. Let's be clear.
And then they can take it to the church, because a lot of people like to put it in the
Sure.
box or the basket that they pass around at church, whatever.
Yeah.
Or we can just mail it directly to that charity institution. But then they're taking money out of a tax deferred account that they never paid $1 of tax on, and the church doesn't have to pay taxes on it either. So it's a win-win.
Are they paying taxes on the distribution of that?
No.
Oh.
Because it's not a distribution, it's a charitable contribution. So it's a qualified charitable distribution, no taxes due.
Interesting.
This is why churches like me in this town.
Yes.
I got a lot of churches that do receive these from me.
Oh, yeah. Well, no, I mean, that makes a lot of sense. Yeah, because, I mean, obviously, if you do a normal, if you give it to, like at my age where I'm not doing any of this, I can, make charitable donations. You can write those off your taxes or whatever, quote unquote. But, usually it doesn't end up helping you all that much, just because they raise the standard deduction so high anymore, that getting over that threshold means that, I haven't itemized since they did that.
Yeah.
And so I'm really not getting much. There's not necessarily a strong tax advantage to my giving. I mean, I give and people should, but so this actually then allows them to actually have a tax advantage for it.
100% at that age. Now, just to be clear, like
70
you and
and a
I
half.
can't do it today.
No.
But when we're 70 and a half, the way the rule is written today, then we could actually do a qualified charitable distribution to a charity of our choice.
So at 70 and a half, you can start doing that, even though you don't actually have to start taking the forced distributions till you're 75.
Mm-hmm. But if you're giving money to a charity, why wouldn't you use tax deferred dollars anyways, right? Like,
absolutely.
Like let's be smart about this, and let's try and make that account, instead of taking it out of my checking account at the bank and giving it to the church.
Right.
I'll take it out of my retirement account and give it to the church, and then hopefully make that account a little bit smaller by the time you reach the age when you have to start taking it out. For you and me is age 75.
Right.
Well, that's kind of the plan, right? So it's not. It's always there's a saying in our business: it's not how much you grow your account to, it's how much you keep.
Oh.
Right? So you want to grow a lot, but you don't, if you take it out all at once, well, you're going to pay a lot in taxes.
Right.
So we want to spread that out. And this is one of the ways you can do that.
Okay.
And even so, it's another thing, when people reach retirement age, their income drops because they're going to a fixed income.
Right.
Maybe they have Social Security. Maybe they have some pension or other, maybe some rental income, whatever it is. But a lot of people are married filing jointly.
Yeah.
And at the beginning of retirement, right? And as you age, then one of us will be deceased at some point, and then you'll have single filer. Well, the tax advantages for joint versus single are big. So even though you don't need the money out of the retirement account at maybe age 65, you don't need it to live on.
Right.
And you're kind of planning on living on it later. We could still be smart about it and take out money when we're in a bigger tax bracket that's more advantageous to us. And even if we don't need it, just reposition it into a different type of an account.
Oh,
into
okay.
a joint account, or into even a Roth conversion is one of the things that people do a lot of times, where you can convert from a tax-deferred retirement account to a tax-free retirement account. If you meet the rules, it's tax-free through the Roth IRA.
Okay. So you could take it out and then, but if you didn't need it, you'd put it in a more of like a standard investment vehicle too, like money market or whatever you want to do.
Yeah, you could put it into cash. You could have it in the bank. You could reinvest it into a joint account, which is typically what I have people do. Is they still want the growth on the money, right?
Right.
But they just don't need to have it in the tax deferred wrapper anymore. So we take it out when you're in a joint filing tax situation,
right?
And then reposition it so that then, if you do go down to that single filer status at some point in your life, because you will. The amount of money in that retirement account that's income tax to you is much smaller, hopefully, so that there's less of an impact.
Gotcha.
Because the interesting thing is people don't realize when they go into retirement, everything revolves around taxes. If you make too much money, you're going to pay a higher Medicare premium. It's technically not a tax, but it technically is. It's a penalty for making too much money.
Really?
Yeah.
Okay. So I didn't realize. So Medicare premiums are income based.
Oh yes. Oh yes.
See, I'm 20 years from any of this, so I was like,
the standard Part B right now. I think this year in 2024, it's around $170 for Part B, Medicare Part B. All Medicare participants pay it.
Right.
That comes out of their Social Security if they're getting Social Security, or they're paying quarterly if they're not.
Okay.
Anyways, if they make too much money though, they could pay upwards to $500. I think it's like $540 a month. I could be off on that a little bit, but.
Wow.
So if they made too much money, that's the kind of like the high end point where you could hit it.
Yeah, make too much money that year.
Yep. Well, and it's also a 2-year lag on how the calculation works. So 2 years ago, if you made too much money, you're paying for it today. This kind of thing.
Oh wow.
Yeah. Anyways, it's government.
Yeah.
So
yeah. Well, that could be some pretty big swings in retirement. I mean, if you're working and you decide not to.
So
and,
not only are you paying more. Maybe you're paying more income tax because you're in a higher tax bracket,
right.
But you're potentially paying more Medicare premium because you made too much money. Oh, by the way, your Social Security that wasn't taxable because you didn't have enough income is now taxable because you had too much income. So you're paying a penalty on your Medicare, you're paying taxes on your Social Security, and you're in a higher income bracket overall.
Got it.
Not good.
Not good.
So let's be smart about spreading that out. And that's why if we defer, and wait until the last moment to start taking money out. Like I just had a client come in, they had to take out $20,000 this year out of their IRA because that's their required amount.
Okay.
Well, $20,000 of income to them is a pretty big deal in regards to their tax situation.
Yeah.
So, do we want to give to some charities this year for
right.
this person? Right. Like we talk through that, but
right.
But that's what I'm talking about, trying to be smart with your tax decisions in the financial planning world.
Right.
And that's not really thought about a lot.
Right. Well, I think when you're, when people when you're younger, I mean, it almost kind of happens behind the scenes, right? I mean, if you're in a kind of traditional job, where they withhold all your taxes for you and you file a pretty easy 1040, or whatever. We're not used to thinking about it. I mean, other than, it's that thing we have to deal with on April and, get our TurboTax or whatever it is. But I think for people in kind of normal, quote unquote, normal jobs where they, it all kind of happens automatically, in the background. So it's not something we're conscious of as much. It's like when the exchanges for health insurance came out and people had to start actually making decisions about what coverage they wanted or whatever. They started offering more flexibility, and everybody freaked out because they were just used to like health insurance is health, and it's just that thing I get from my employer, and everybody's is the same. And you're like, well, no, there's choices now. And I remember the comparisons like, but you do that with your car insurance. Like we've always done that with car insurance, but we're not used to having to think of something. We're not having to think about something we're not used to having to think about. It just sort of is what it is, I think, during your working years.
It's not fun to think about, to be honest with you.
Well, it's not fun, and it's easy to ignore. And again, it's just sort of, there's kind of defaults when you're younger in working years. I mean, the big decisions are, do you do a traditional IRA, Roth IRA, those kind of things. You're making those kind of decisions, but you're not thinking about it strategically in the way you talked about. No. Unless you're a small business owner or something like that. If you're in kind of a typical employment situation, you're not. But now you have to, and that's why you want somebody like Roy around who can help you do that, because there's ways of doing it. The default way you might stumble into will probably be not advantageous to you.
Yep. And that actually goes, so we kind of talked about like retirees and you're over 70 and stuff like that. Well, there's easy ways to do that. But when you're saving in your work life, I always try to talk to people about the concept of we're not looking at just always the current year, right? But that's where so many people live, like tax-wise.
Right.
What's my current tax year look like? Well, I'm actually looking at people's life arc. And when we can have income tax diversification, that's the most powerful, so it gives the clients the most flexibility when they reach retirement. So what I mean by that is, do we save in a Roth IRA? Do we save in a traditional IRA? Do we save in a regular taxable account?
Right.
Right. And those can be through your employer would be a 401k, traditional 401k, or a Roth 401k, or really you can only do a taxable account through someone like myself or your bank or something like that.
Right.
But when you get to retirement, if you have money in all three of those buckets, you have much more flexibility. So let's say you need $100,000 for whatever. Maybe you're doing a rental home.
Right.
But if you take out $50,000 from a traditional account and $50,000 from a Roth account, there's a much, much, much different tax impact.
Okay.
Right?
Yes.
To you overall. Whereas if it was $100,000 of income, right, that's a huge impact to your taxes.
Right.
So
Because
that's an extreme example. Usually we're talking like $5,000 to $10,000 situations, but
we could. I mean, so because in the Roth you're gonna lower tax burden.
there's no tax
That's
burden
right,
on the Roth
right.
in retirement, right?
In
So
retirement.
you put it in, just to give everybody clarity on the Roth IRA. You put money in today when you save it.
Right.
You've paid your taxes on it
already.
It grows tax deferred, and you receive it tax free if you take it out through following the proper rules. So you have to reach age 59 and a half, and you have to have had it like 5 years.
Right.
So if you meet those basic rules, you're going to get tax-free growth on that money. There's zero tax burden to you.
Right. So I this is something I actually know a little bit about, and it's somewhat unique for, I think it's a little clergy uniqueness, but for like clergy in my position where I live in a parsonage, right? Great benefit to me, but it means I'm not building equity and all that kind of stuff. So one of the things they always strongly recommend that we do is I have a Roth version of places I can, of my investments, of my retirement investments. And they're like, you want to put everything in there because when you retire, you might want to pull out a lump sum to put significant down payment or just straight out buy. I mean, I know clergy who've written $200,000 checks to buy a condo to move into retirement because they never owned anything.
Yeah.
And there's a huge difference, and they actually drilled that into our head. There's a huge difference between which box on this form you check about what that looks like when you pull it out
In the future, yep.
If you like, you may save a few dollars now if you do, the tax, pre-tax, and that sounds good in the moment, but long term, especially if you're looking at doing something like that, it's not a good decision.
Yep.
So that is one where you do need to be thinking now.
Yeah.
About that time if there's something like that on your horizon.
The concept is income tax diversification for your future.
Right.
But you have to make decisions today to actually make that work.
Yeah. Well, I imagine there's other people. If you live in a place, like if you live in a city or something like that where, everything's apartments, right? You're not going to own anything because you're always just going to rent because you live in like New York or San Francisco, like someplace like that. You may, when you're in retirement, want to buy a place, move to Florida and buy someplace, so you might be in that similar situation where you need to pull a big lump sum out of whatever you have. It's really nice to pull it out and not have to pay a whole bunch of taxes on it.
Yeah, exactly. It's not what you earn, it's what you keep.
Yeah. Yeah.
It's a big thing in the tax world.
Yeah.
Right. So making decisions around that are really where I help people plan today how much to be saving, how to be saving it. And you have to always have to balance that with, the CPAs are awesome for a reason.
Yeah.
Right. They're trying to help you make good decisions in the tax year you're filing. But it's in my purview, it's short-sighted. So having a CPA, having a financial planner, both of those together are very helpful to have around you as a professionals that can make sure we keep you on track in the tax year, but then also are we making the most prudent decisions for the long term? And maybe at a certain point you say, well, I don't need to have all that tax benefit this year. I can do some of it into that Roth that you're talking about.
Right. I
have to pay taxes on it this year, but I know that that's for my future and I'm in a decent tax bracket this year.
Right.
And I always ask people, do you think taxes are going up or down?
Well, traditionally speaking.
Well, I mean, when we're adding $1 trillion a quarter right now,
Right.
trillion a quarter,
You're talking about the national debt.
the national debt,
Yeah.
our taxes going up or down.
Yeah.
The numbers on Medicaid in Colorado are not good either. The last I saw, it was I believe it was around 50% of residents of Colorado on Medicaid.
Wow. Okay.
So again, that's Medicaid is a tax burden on the populace.
Right.
So
Yeah. You pay taxes for that too. So.
Mhm.
Yeah. So I think that's why it's important to do these check-ins every once in a while and be like, okay, what are my goals? And to have somebody like you, we talked about this in the financial planning, is as comfortable as it might be to, like, bear your financial, self-bear to somebody. I mean, little things now. I mean, again, like, which box do you check on this?
Mm-hmm.
And the truth is, like, on mine, like, do I really notice the difference? I mean, would I notice a little bit, but not a lot? But by checking the right box, I hope I'm making a huge difference down the line. So yeah. And sometimes you just, you need to just pay as you go. So, the situation that I asked you about personally a little while ago. So I, am probably more of a, kind of a traditional person in that most of my experience of investing has to do with retirement accounts, which obviously have some tax things as far as, like, whether it's pre-tax or post-tax when I give it, and then tax things when I take it out. But as it's sitting there growing, I don't have to do, there's nothing for me to do with it now as it's growing, right? I mean, I'm not, versus the money market that you helped me set up that I was a little surprised by this year, and I don't know why I was surprised.
Surprised you had to pay taxes on it?
Yeah, and then I'm like, oh, and I gotta, like, what is this? And I'm like, I'm like, oh, I made income on that account. Now it just stayed in the account and just continued to grow because it's the glories of compound interest. I mean, right? That's what you want. But I'm used to looking at my investment returns in my retirement account and going, oh, those are great returns. That's wonderful. But I don't have to pay taxes on that money yet. I'll have to pay taxes later. But on that one, I'm like, oh, I gotta pay taxes on that $4,000 of whatever interest and dividends that I made. And I'm like, even though none of that's I could take some out to pay the taxes if I wanted to. I suppose I could take part of it. But so that was like, huh. And you said something about that, you just pay as you go.
Yeah, well, and that's that third account I was referencing, the taxable account.
Yeah.
Right. And it's an equally important income tax diversification bucket, because that money has no restrictions on when you can pull money out of it.
Right.
It's really important for people to understand that. And you can treat it like long-term money, but you do pay taxes as you go. There are tax-efficient ways you can invest in that account,
right,
by the way, that will hopefully help you avoid taxes to some extent,
right,
into the future, I should say,
right.
but it's another really good account to have and to have that money in. And a lot of people are like you this year, and they're getting all this money moved into money markets because the banks are paying nothing on cash, so we move it into money markets,
right.
And they're paying over 5%. Well, shoot, I've got people, they're like, wow, I've got, $5,000 of interest this year, Roy, from that one account. And, in the year prior, rates were darn near zero prior to COVID and in COVID, right? And they weren't getting $50.
Right. Well, and I think and I'm wondering if more people were kind of in that surprise category for me, that I was in. You're like, because we're not used to, it's been a long time since we got any decent amount of interest. I mean, I used to get those interest statements from my savings account on my bank, and it's just like, for tax purposes, I'm like, great, we paid you 37 cents in interest this year. And I'm like, fantastic. Why'd you even print the piece of paper?
I think some of them actually made rules where if you didn't make certain number of interest, they didn't even send it to you.
Yeah, that's probably a good idea. But that's a different thing. And you're right. And the flexibility, is nice, and there's some advantages to it. I mean, as I had to call you and be like, hey, I'm taking my daughter to the UK, and I need some money because I don't want to put it on a credit card. And
did I hold it hostage?
No, you did not, Roy. You said you didn't even ask the reason, and I volunteered why I was doing it. But no, you were like, okay, sounds great, and it was taken care of, and now I've got it, and I can go, and I'm not going to come home to a sobering, sad credit card bill.
Well, that's part of the living.
Or at least I'll come home with a credit card bill I can pay.
Yeah, well, that's part of the living today part, right? We talked about that, and you have to live today, but also you're also planning for tomorrow. You're doing the right things. Right. And that's why I can confidently, support that.
Right.
If it was your last $10,000, you know what I mean? Well, now we got a problem.
Yeah. I suppose if it was my last 10 grand, I'm like, I'm going to, run away to the Bahamas or something. You might be like,
Put it all on black, baby.
Sure?
You might as well just roulette it. Maybe you'll have better luck.
Yeah, I don't think that's good financial advice, right?
Probably not.
So, good. All right. Well, what else do we need to know about taxes, Roy?
Well, so I'm kind of curious for you.
Ooh. Put me on the spot.
What is your experience with how you guys, your household, right, previously, would make decisions around taxes? I'm just curious on what the thought process was or how much that was even part of your decision making.
It was, in fact, I mean, most of the conversation we had around taxes was just being in my unique situation of being a clergy person, just because our taxes are weird. Right, because we're technically self-employed for some circumstances and not for others, income, it depends if, what my income is, if it's my cash salary, it's my housing allowance, if I'm in that situation or, whatever. So we did have to think about it, in that regard, kind of strategically, but otherwise, it didn't come up a ton.
Like when you set up your, do I claim 1, 2, 0?
Yeah, but that's not a thing anymore, is it?
I don't actually know.
I don't think so.
I
don't think so. I think there was a time when when we first bought our house in Albuquerque, we went to the guy who was doing our taxes and said, how many should I claim? And he's like, this many. And I wrote that number down, and I think I wrote the same number down for like the next 15 years, even though, even sometimes I was renting, and all that sort of stuff. And then, it was just kind of nuts. So I must confess, not a whole lot. Anymore, I think it's just, I look at what, this year was. Did I have to pay? Did I get anything back? And try to adjust it. I am one of those people who tries to adjust it. I don't really want a large check from the government. I don't want to write them a large check either, but I don't really want to get a large refund because that means I pay too much.
Well, and that's
and they held on to my money without paying me interest.
I'm glad to hear that, because that's actually one of those things where, as a financial planner, I struggle with people who are like, I want to get my big refund back from the government because that's my vacation money or my this money or that money, and I'm like, you do know you're giving the government your money for free, right?
Right.
And right now, interest rates are at 5%.
Right.
So you could be getting more money on your money.
Yeah.
You just held on to it.
I do think it is almost like a forced savings thing or kind of an out-of-itemized savings thing. And I mean, if you're not going to save, and people are not great at saving. So if that's the only way you're going to save, I'm like, all right.
I can understand it, but I don't support it.
No. I definitely try to kind of dial it in there and just to say, okay, I'd rather, my goal is plus or minus 1,000.
That's a really good place to be.
I don't mind. I'll write a check for up to $1,000 if I have to, and not feel particularly bad about it. I'll get back about 1,000 and not feel bad about it. Any more than that, I'm like, I got to make some changes here and tweak what I'm doing.
Got it. So with work, being a pastor, are you familiar with the health savings account?
Oh yeah,
Okay.
yeah. I love my health savings account.
So you have a health savings account.
Yeah.
Okay. So why do you love it?
I think because I am not my regular healthcare usage isn't particularly high. So I elected to go that way, where I have a slightly higher deductibles and all that kind of stuff, pay a little bit more out of pocket, but then I have more of my money than basically the premium gets directed into the health savings account, and it gets saved there.
Do you taxed on that?
I don't believe I do.
No, you're not.
No, I know.
That's why I'm trying to come here with you.
Yeah.
So you should love it because you don't pay taxes on that money.
Oh, is that why I love it?
It goes towards your health care.
Okay. I think I did know that. Yeah. I do. And the thing I was actually surprised by the other day is if once you cross a certain dollar amount, there's even there's a kind of a risk-free investment option too, where there actually are, I'm sure it's like money markets or something pretty crazy, but pretty mild, but you will actually make a little investment income on it too. But that's when I had my LASIK surgery. I mean, I basically just saved up my HSA money for about 3 years, and then that gave me enough money to pay for my LASIK surgery.
So same thing, not what you make, but what you keep. So if you're saving that money And you would have paid that out of pocket
Yeah.
otherwise, right? But now you paid on money that was never taxed
Yep.
to get that service done. So that's, an HSA is another place where people can save, not just in retirement accounts, that can be for their benefit tax-wise, right?
Right.
So, as a single person, you don't get to save as much as a family. If you have a family plan,
Right.
then you get to save a little bit more. But yes, absolutely. I don't go to the doctor a lot myself either, so I usually just have that thing piling up in there, and I'm not spending much of it, and I'm starting to invest some of it. And that depends on the HSA plan you're in,
Right.
by the way, on what you can do. But it's a really good tool. So if any of the listeners have that option and you're not taking advantage of it, you definitely need to, because if you don't spend it, you don't lose it.
Right.
There are some that you do, and I want to just quickly mention that
Right.
because there's a flex savings account, FSA,
Yes.
and that is more of a use it or lose it in that
Yeah.
tax year.
Yeah. There also can be an HRA, health reimbursement account.
Oh,
And those are the options we're offered in the pool of plans we're offered as clergy. And it's like, it'd be nice if this wasn't one letter difference, because there's a huge difference
right?
between these two
Check the long
accounts.
run.
And the HRA is like the flex, and you can only roll like a little bit. I mean, it's use it or lose it, and you're just like, which is not very helpful. Good. I'm glad, because I actually sat down and figured out, okay, here are my premiums. Here's what it's going to cost. Here's what's left over. That's going to get put in here. Here's the maximum amount. So I'm going to contribute like $136, a paycheck to basically max it out.
Max it out.
And our
Retirement account through a company.
Yeah.
And that didn't used to exist. So I actually heard a story one time about a lady that had money going into her 401k her whole career and was never invested. It just sat in cash.
Wow.
So the compounding effect that she could have had was zero.
Right.
And she thought the whole time that it was being invested, right? And this is older period of time when technology wasn't so easy. You could just log in and look at everything, right?
Right.
But part of it was on her for not paying attention.
Right.
But part of it was also on just the educational aspect around it from the company and just doing that. But paying attention to your own, nobody's going to take care of your finances but you.
Yeah.
Right. So we have to be responsible with that. It's very similar to nobody's going to take care of their own faith except for themselves. Right. It's not.
Right.
It's not your job as a pastor to take care of someone's faith. It's to help educate and guide. Right. That's why our careers are so parallel in regards to how we approach things, because it's very similar.
Right.
Right. And it's a fun and fulfilling thing for me to do that and help people be able to feel prepared for life.
Yeah.
And you're just doing the same thing in the spiritual realm, right?
Yeah. Well, I'm trying. Oh, okay. So it's funny. It's funny you mentioned that story, because actually I had something very similar. This maybe actually isn't necessarily even a good example. When I went to seminary, the last thing after I left my job, the last thing I did was cash out the 401k there and roll it into that same IRA I had set up with that company all those years ago. And I filled the paperwork and it rolled it in there. Great. Completely forgot about it for like 3 years. And then they called me 3 years later and said, do you know you have this money that's been sitting in cash for 3 years? And I'm like, no, it didn't get invested the way all the other stuff was invested. And they're like, no. And like, because you didn't check a box, or whatever. But it wasn't a lot of money. Relatively speaking, which is, why they're like, yeah, it's been sitting there. However, because it was sitting there, I missed the 2008 crash, because it was 2009 that they called me. It's like, you should probably invest this money now.
Dumb luck.
Yeah, it's like, you are the luckiest person I've ever seen. I'm like, well, too bad it was like 20 grand. It wasn't like, it was something, but it wasn't like, I'm like, oh, well. But he's like, but that's what it took for them to notice. God knows how long it would have just sat there, in cash. But it sat for 3 years in cash doing nothing. And so, I also missed out on a lot of, good stuff, too. So but I wasn't paying attention. They didn't ask. I didn't ask. Nobody wasn't working with somebody who was asking me questions about it.
That's a perfect segue into the next portion of the financial planning journey, is that I require clients to meet with me at least once a year.
Yeah.
It can be virtual if we need it to be, because, I do have clients all over the United States, but we have to get together once a year just to go through where is everything at.
Right.
And let's look at everything and make sure we understand it. And if I don't understand if it's an investment and I don't know how it's invested, I'm always asking for a statement.
Yeah.
Like, okay, I want to see how is it invested to confirm, right, that it's pointing in the same direction as everything else.
Yeah.
And that just health, just like going to the doctor, you need a health checkup. Right.
Yeah.
You need a financial checkup once a year.
Yeah.
You need a health checkup once a year, just to make sure we're staying on the course that we originally set. And also, Did anything else happen in the last year that I'm personally not aware of as the third party here in the situation that maybe didn't get all the memos, right?
Right.
and does that adjust our plan at all? The best part, honestly, I actually had a client in the other day. It was really funny. They were like, "Wow, you're one of the first people that ever told us we needed to take a vacation." Because they were working so hard and they talked about their goals and what's important to them, and they were so on track with everything. I'm like, you guys really need to reward yourselves for how hard you're working and go on a vacation.
Right.
And they did, and they shared with me that, when they took the kids and the kids they're teaching their kids well, and their kids are understanding the fiscal responsibility, and like they don't want to spend too much money on frivolous things and yada yada. And they went on this trip and the kids wanted something, right? And the mom and dad were like, no, trip is paid for. You guys can do what you want. If you want that, we'll get it for you. It's paid for. We saved to make sure that we could do this and have fun and just enjoy it together. Right. They actually, how many people go on vacation, put on a credit card and just like, oh, I'll worry about it later. And there's still this like little bit of fraught tension in the background that is going to come due later, and to have it up front paid for, and just the fulfillingness of showing your kids that we did this and we were responsible and we can enjoy this to the full extent and not have any regret or guilt for doing it.
Right.
That's empowering.
No, yeah, absolutely. I'm getting ready to take my daughter to the UK at the end of May. It's her 13-year-old trip. We did the same thing for my son. But we knew this was coming. We knew it was coming, years in advance. So we saved, and so now when it came time to buy plane tickets, the money was there. When it came time to buy, whatever, and, all that kind of stuff. So I'm very excited to go and take her and have that experience with her. It would be a little curtailed if I was watching like a credit card bill, or credit card balance would increase as I was doing it. And, I will have to be, somewhat reasonable. I mean, you're not bringing home any diamond chandeliers or anything. But we'll be fine. It'll be fine. And it won't be anything I have to worry about while I'm there.
Yeah.
But because I plan, we've been planning this for 5 years.
Yep. The range of where you need to be. Yeah. And that goes back to the live today, but plan for tomorrow.
Yeah.
You can't just plan everything for tomorrow. You have to have some fun along the way.
Yeah.
Doing this podcast is one of those things for me it's been a lot of fun.
Mm-hmm.
I'll actually come out, after we're done, I'm kind of giddy about things just because it's fun. It's different. It's fun. It's educational. You're hoping and you're reaching other people that can learn a nugget of information that could help them on their journey of life, financially or otherwise. And that is, having that fun along the way is really important.
Yeah, absolutely. Yeah. Absolutely. So, that's interesting. You didn't tell me to take a vacation.
Well,
I only work 1 day a week, so it doesn't really matter.
That's right.
Like how many vacation you need. But the annual checkups are great, and I have really appreciated that. I have my personal experience with that has been really positive, and it's just to be able to check in and go, okay, because it's out of sight, out of mind, a lot of it, and sometimes it's just nice, like, okay, actually if things are fine in our last checkup, things were fine, and so you're like, okay, like I don't. It's not something I'm not thinking about it, but I also probably don't. I just need to, as long as I continue on the course that I'm on. I'm on a we're on a good course now. So now I'm just like, okay, so that's one less thing to stress about. Like if something shifts, absolutely, then I need to take that on account. But it's nice to know, like, all right, I'm on path for the plan that I have, and you're like, great. Like that's a little peace of mind to go, okay, I'm not. Now I can, if I worry about it later, I'm like, nope, that's right. Roy said, this, and this. Like, that's right. We're okay.
Yeah.
Peace of mind, man. Peace of mind.
The peace of mind is everything. And it's interesting because I think going to a financial planner is potentially, let's say it's like a dentist or a doctor. Do you particularly look forward to it? People who in the beginning of a relationship with me, I would say probably not. Mm-hmm. Because they don't know what they're going to experience.
Yeah.
And then when you start getting, my mom's favorite statement, your ducks in a row, right? And things are getting organized and you know what's happening and why it's happening.
Yeah.
What I've found is people view it as less of going to the dentist, which there's just always some, you're wrought with anticipation, but it's more like going, and kind of having a nice conversation with a friend, if you will, somebody who's a champion for you in life and you look forward to it versus being like, ugh, I have to go talk to Roy. Now, the people who don't like to talk to me are people who they know they're in a bad financial position.
Right.
They're potentially not making the decisions they need to be making to alter course.
Yeah.
And they don't want to come talk to me because they know.
Right.
They know before I even look at anything. They know.
Yeah.
So it's a much different experience, though, when you feel good about what you're doing, why you're doing it, understand what you're doing, make good decisions, and coming in and staying on track is very easy to do.
Yeah.
Getting on track is where the most difficulty comes for people, because sometimes you have to make lifestyle changes to do that.
Right.
Which, again, not my job to tell you what you do or what decisions to make. It's just to educate you around the ramifications of those decisions.
Right. Well, and I think that's important. I think, it's that other side of it that's maybe, important, as important, if not maybe even more important, is the accountability piece to it. I mean, there is a little bit of accountability when you have to sit down and look and go, okay, like this is what's going on, and deal with the numbers. Then there's an accountability piece comes with it, but it's also like a self-accountability, right? Like you're not setting other people's goals, right? You may be reminding them what they said their goals were, but there's a self-accountability to it to go, am I doing what I can to get to where I say it is or I think it is that I want to go. And when you are, that probably feels great and wonderful, and of course, but if something's happened or, you maybe made a decision that maybe wasn't the best, or, life got jumped up and bit you, which happens sometimes, that accountability doesn't feel necessarily wonderful, but we also need it. That's also like the tension in the church, right? I mean, I live with that sometimes too. It's like people need accountability, right? And you try to do it as gently and as nice as possible, but we do get off track, sometimes in our lives in all sorts of ways. And I think about that even in terms of like I don't mind going to see my doctor when I know my diabetes is well controlled and the tests are all going to come back fine. When it's not, and I know it's probably not, and the tests are not all, and the numbers aren't going to come back fine, I'm not looking forward to it. Even though at the end of the day, they're not the ones that have to deal with it, right? They're just going to look at me and go, these aren't where I'm supposed to be. Like, yeah. But I also know if I don't go, I need to go. Like I need the accountability of going.
Yeah.
So I mean, there is that kind of, it's almost like kind of being like a personal trainer, right? Like you're there to, cheerlead and help and motivate and all of that too, which I think is helpful and great. And sometimes that's wonderful and inspiring, and sometimes it's just like, yeah, you're telling me things I need to hear. Doesn't mean I want to hear it.
It's for me personally, it's very fulfilling.
Oh, I believe it.
Even in the tough conversations.
Yeah.
Because those people need to hear that.
Mm-hmm.
And I've seen people make changes in their lives that got them on track to be in a much better position financially.
Nice.
Making better decisions. That's very fulfilling to me. One of the most fun things, though, I would have to say, is when I'm doing people's financial plans and I'm basically creating a balance sheet of their assets and their life, right?
Yeah.
Financially speaking. And for them to be able to see that end number, my assets, my liabilities, where's my net worth at, and hitting $1 million for people is a pretty awesome threshold in today's dollars, and probably won't be the same in 10 years, right? But that is really fun. I had some clients hit it the other day, and they were just so excited to see that they crossed over that threshold, and they were like, "Man, our hard work is paying off, and we're doing really good things financially speaking, and it feels good, but we're also having fun along the way. We're enjoying life." That's so rewarding and fulfilling. It just makes this job amazing.
Yeah, I believe it. Well, is there anything else we big area of financial planning we didn't touch on?
I don't think so. I think that gives a good broad brush strokes here of what the heck it even is, and what the experience would be if you sat down with someone like me. Is just like, okay, we're going to take a look at your financial position on everything.
Yeah,
we're going to take a look on, your income and your tax situation.
Yes.
We're going to take a look at, what is actually important to you and actually have those conversations. And honestly, a lot of times people can't answer that right away. I want to retire. Okay, let's dig into that. But that's a big part of that. And then it's helping people stay on track for that. And like you said, the accountability piece of you, if it will, by having a once-a-year review.
Yeah.
And then having appointments as needed as life changes, because it does. And we just have conversations when we need to around those things.
Yeah.
And that's what a financial planner does.
Yeah.
And it educates you. What did I say? The statement, it was pretty good. I should say I should write that down. But I'm empowering people by educating them to make good financial decisions.
Yeah. Yeah, I like that. That's a good line.
Yeah.
There you go. See, you got an elevator speech.
I learned something from my podcast today.
There you go. Hope somebody else does too. Well, thank you. I really appreciate it. I think most people, my hope for most people would be for them to have the same experience that I had, which is, yeah, maybe you're not necessarily looking forward to it, or it's just something you feel like you have to do. But I'm guessing, and my hope would be most people came away the way that I felt like, which is that was far more interesting, rewarding, and satisfying, even, you know, those first couple of conversations we had than I expected it to be. And I think it's always nice when things are better than you expect them to be.
I always like to under-promise and over-deliver.
Yeah. So, well, thank you all for joining us for the About podcast. Roy, thank you for sharing your amazing, well-earned wisdom with us once again. Really appreciate it.
Yep. Thank you for hustling. We'll see everybody.
See ya.